When we talk about portfolio diversification, we often talk about assets like equity, gold, bond, and real estate. And we often assume that the person can easily diversify his or her portfolio. The problem here is real estate investment requires a large outlay of cash, and it's not easy to add in your portfolio. Well, not anymore. Thanks to REIT or Real Estate Investment Trust, wherein you can invest as little as 5,000 rupees and gain exposure to the best-in-class commercial real estate in India. Hi, this is Karthik Ramappa, and in this video, I'll share a simple 5-step process using which you can analyze an REIT and make hassle-free investment decisions. At the end of the video, I'll also share some bonus information that will come in handy. So do watch the entire video. Conceptually, a REIT or a real estate investment trust is very similar to a mutual fund. If you understand how a mutual fund is structured, then understanding REIT is quite simple. In a mutual fund, the AMC collects the funds from retail investors, pools that money, and the pooled money forms a large corpus, which is then invested in the market. Which stock to invest, when to exit is a call that the fund manager and the chief investment officer of the AMC makes. Likewise, in a REIT, a trust entity is formed. It then solicits investments from retail investors, pools all that money, and then the money is invested in large commercial real estate. In mutual funds, the underlying is stocks for equity mutual fund, bonds for a debt mutual fund. Likewise, in a REIT, the underlying is commercial real estate. Real estate can be in the form of shopping malls, hospitals, large IT offices, or commercial buildings. Now think about real estate investments for a moment. Why would you as an investor want to invest in a real estate? Well, you do that for two reasons. One, you want to benefit from capital appreciation, wherein the value of your investment increases over time. Two, you want to benefit from rental incomes. Well, this is exactly what happens in a REIT. Against your investment, you get REIT units, just like the mutual fund units. The REIT unit or the NAV of the REIT increases over time as and when the underlying commercial real estate value increases. Plus, you're also entitled to get the regular rental income against the REIT units that you hold. Think of it as the dividend that you get for the stocks that you hold. By regulation, the REIT entity is supposed to pay out rental income to you at least twice a year. So that's the least minimum you can expect if you hold an REIT unit. In a nutshell, REIT is a pass-through structure wherein your funds are invested across real estate properties and you get to enjoy the rental income and the capital appreciation on the properties as such, without the ordeal of dealing with actual property transaction. You don't really have to worry about the paperwork, you don't have to worry about building maintenance, you don't have to worry about negotiating with your tenants for rental income, or in the case that your tenant vacates, you don't have to look around for new tenants. All that headache is outsourced to an REIT entity, and you as an REIT investor get to enjoy just the benefits of real estate investment. Another good thing to note here is that by regulation, an REIT entity is supposed to invest 80% of the funds in completed real estate properties only. That means to say that the funds that you invest will not get sucked into construction of a building. Now, all these things that I just discussed are the easy things to understand about REIT. The real question to ask is, how do you actually analyze an REIT fund? A few years ago, there was just one REIT listed on the Indian exchange. Today, there are 4. With the boom in commercial real estate space in India, you can expect many more going forward. In a sense, analyzing a REIT fund is very similar to how you would analyze a debt mutual fund. Remember, we discussed how to analyze a debt mutual fund in an earlier video. I'll leave a link to that in the description below. Please do watch that in case you haven't. In a debt mutual fund, you need to dig into the portfolio of the fund. Likewise, in a REIT also, we should always start with analyzing the portfolio. Why is that? Well, you need to ensure as an investor in a REIT entity, your funds are being invested in good quality commercial real estate. For the sake of this discussion, I'll pick Mindspace REIT, but in no sense this is a recommendation. I'm using this just for illustration. Step number 1 requires you to evaluate the portfolio. In particular, you need to see what type of real estate is the company investing in and what is the geographic spread. As you can see, Mindspace has presence across Mumbai, Pune, Chennai, and Hyderabad. The next thing to figure is what kind of properties they are investing in. From the reports, you can easily figure that the company is investing in large IT office spaces. Note that there are REITs which have a much more diverse portfolio. They have exposure to hospitals, shopping malls, commercial buildings, IT offices, etc. If you like diversification, then you can consider REIT which has a diverse portfolio. Otherwise, you can stick to concentrated bets like Mindspace. This is up to you to analyze as an investor. But there is a small advantage if the company has a concentrated portfolio. It becomes easier to analyze. For example, in case of Mindspace, their exposure is only to large IT companies. So you need to understand how the IT sector overall is behaving. Also, do pay attention to who the clients are. This will give you a sense of stability in rental income. In case of Mindspace, from their reports, I can easily understand that 74% of their clients are MNCs. And the top 10 clients are of good repute. Do spend time to understand how much each tenant contributes to the overall rental income. The idea is to figure out if the REIT is dependent on just one or two clients for a large portion of the rental income. Now, if that is the case, then that's not a good sign. Also, the geographic spread is super important here. You need to ensure that the REIT is making investments in cities and towns where the ease of business is doing very high. There should not be geographic concentration risk. The cities that they're investing should not be caught in political limbo, rampant corruption, and minimal progress. Let's move ahead to the second step. In second step, we evaluate the financials of the REIT. There are three particular things that you need to look for. The revenues, which also makes up to the rental income, the net property income, and the attributable share price per unit holder. Revenues largely include the rental income, but sometimes revenues can also include revenue from maintenance services. Here is how it looks for Mindspace. Two things to note here. One, the revenues are increasing, which means to say on a consolidated basis, the rental income is increasing. But when you're looking at this, you also need to look at it from a historical perspective and not just the year-on-year basis. Next up is the net property income. Net property income is basically revenue minus expenses. Revenues in this case happens to be the rental income, and expenses is basically the property maintenance expenses. So evaluating the net property income gives you a sense if the REIT is profitable on a net basis. This is like evaluating a company's EBITDA levels. Finally, after adjusting for expenses and taxes, you need to ensure that the REIT is profitable so that it has distributable income to unit holders. In case of Mindspace, as of March 2023, the distributable income on a per unit basis is 249. Let's proceed to step number 3. As you can imagine, investing in large commercial space requires a large outlay of cash. So it is inevitable that an REIT borrows funds. Borrowing is fine as long as they can service it and manage it properly. Hence, evaluating the debt position of a REIT is extremely crucial. One key thing to look for is the interest coverage ratio of the REIT. In normal terms, interest coverage ratio is equal to EBITDA divided by the finance charges. If you were to do this math on Mindspace, you get an interest coverage ratio of 4.5 times. This means to say at current financial position of the company has a 4.5-year runway to service its finance cost, which is not bad. Generally speaking, higher the better. While evaluating the debt position of an REIT, it is important to evaluate what is the weighted average cost of debt. In case of Mindspace, it is 7.7%. Obviously, lower the cost of debt, better it is for the company and for you as an investor. Lower number indicates better interest coverage ratio and also better profitability. Along with the weighted average cost of debt, it is also important to understand what is the weighted average maturity of debt. This tells you what is the average tenure of the loan and how quickly the company has to refinance itself. For Mindspace, this is 5.4 years. Intuitively, a lower cost of debt and a longer tenure implies that the company has locked in a great financing option. On similar lines, a higher cost of debt with longer maturity is not a great spot to be in. Step number 4. Look at occupancy and the tenant lease arrangements. This is straightforward. Higher the occupancy rate, more stable is your rental income. Declining occupancy rate is not a great sign for two particular reasons. One, you don't have sticky customers and therefore they're not renewing the lease. Two, Maybe there are better alternatives in the market, maybe more attractive properties, and therefore your clients are not sticking with you. You need to look at the occupancy rate not just on a year-on-year basis, but also the historical trend. Next up, you need to see the average tenure of the lease agreements. In the REIT world, this is called WALE, Weighted Average Lease Expiry. The WALE profile of an REIT gives you a sense of how and when the lease agreements are up for renewal. Now this is a bit tricky. Shorter WALE means that the renewals are more frequent, which also further implies that the REIT company is in a position to negotiate higher rentals. But it also means there is more volatility in rental cash flows. Longer WALE numbers implies that the rental income is stable, but perhaps the rental income may not have that kind of increment that you would desire. As you can see, the WALE for Mindspace is about 7 years, which I think is alright. Lastly, when it comes to tenants and occupancy details, do look at the tenant retention. Higher the retention, better, as it provides stability in rental incomes. We now move ahead to step number 5, the last step in analyzing a REIT. Here, we look at the valuation of an REIT. Under valuation, we look at 4 parameters. Fair value of NAV, price to book ratio, dividend yield, and the price movement of the NAV. The fair value of an NAV is based on the company's assessment of all the assets it holds. The fair value gives you a sense of how the company perceives its assets and the value it attributes to the real estate assets that it holds on its books. At the time of recording this video, here is how Mindspace assesses its fair value of NAV. It is Rs 371.9 per unit. Contrast this number with the current market price, and you will get a sense if the NAV is cheap or expensive. But do take this conclusion with a pinch of salt. I think it's a fair assumption to make that the company is obviously biased towards making a favorable assessment. Next up, you can look at the price to book of an REIT. You can calculate the price to book value of an REIT by dividing the current market price by the book value. The current market price can be fetched from the exchanges and the book value from the P&L. If you do the math, as of today, the book value is roughly about 1.23 times. Alternatively, if you don't feel like calculating this yourself, you can also look at third-party websites like Morningstar to see what the price to book value is. Now the good thing is you will not only get today's price to book value, but also get historical price to book value and see how it has trended. Next, you need to look at the dividend yield. To calculate the dividend yield, you need to divide the distribution per unit or the DPU by the current market price. At current market price of 308, the dividend yield works out to about 6.2%. Now you need to compare the dividend yield with the risk-free rate in the economy. You can consider a simple bank FD as a proxy for the risk-free rate. It is a good thing if the dividend yield is higher than the risk-free rate in the economy. A good dividend yield plus a good capital appreciation makes up for a good investment in REIT. The last aspect you need to look for in a REIT is the price movement of the NAV. You can apply your standard technical analysis here and evaluate things like support and resistance. It makes sense to buy the REIT when the REIT price is closer to the support value. With all these things put together, you should be up to speed on how to evaluate a REIT. Now here is the bonus information for you. As of today, there are 4 REITs listed on the Indian exchanges. The average daily traded volume ranges between 5 to 10 crores. Not a great volume, but the good news is there is market making. If you are an investor wanting to invest, let's say 5 lakh rupees, then you need not have to worry as you will get your fills easily. But while placing orders, make sure you place limit orders, or probably you can use an iceberg order with 5 to 10 legs. Also, once you make an investment in a REIT, ensure you review the annual report regularly to see that things are on track. Now before I end this video, let me summarize everything for you. Step 1. Look at the portfolio of a REIT. Look at what kind of properties they are investing in and their geographic spread. Analyze their top tenants to get a sense of the financial strength of the tenants. MNC companies as tenants are usually good to have. Step number 2. Look at revenues, net property income, and the attributable share per unit holder. Step 3. Look at the debt position of the REIT. Evaluate the interest coverage ratio, average cost of debt, and average maturity of debt. Step 4. Look at the occupancy and the tenant lease arrangements. Pay attention to occupancy rate and WALE. Step 5. Look at the valuation. Look at the fair value of the NAV as per the company's assessment. Look at the price to book. Look at the dividend yield by dividing the distribution per unit by the current market price. And finally, you can also apply standard technical analysis on the NAV. I would like to end this video by reminding you once again that I've considered Mindspace only as an example, and it is not a recommendation to buy or sell. Happy investing.